clearly the energy situation and higher gas prices is having a tremendous impact on the pricing picture in Germany. What does this mean for the ECB? Isabel Schnabel yesterday came out, guns blazing, saying she doesn't think a recession is necessarily going to be enough to bring down inflation. And it feels like this data really supports that view.
Yes, and I think this is an interesting point. And I think Christine Lagarde, in her blog a few months ago, also made the point that in Europe, contrary to the US, inflation is imported through the energy crisis and it's not sort of as endemic through this massive labor market shortages. And therefore, raising rates alone won't be sufficient to bring down natural gas prices. But I do think, however, that if we go into a rationing plan, as Germany is considering as we head into the winter, you could actually see a pretty significant demand destruction if you are literally sort of shutting down energy supply to some part of the industrial complex, in which case you would have to have a deep recession to create enough demand destruction for gas prices or energy prices to go down. And you see that already when it comes to energy prices. I mean, the oil prices, for example, are down to pre-Ukraine crisis levels. So I think it's not a question of whether we should see a recession or not. The question is how deep the recession needs to be to bring down inflation.
Do you think that markets appreciate that? I mean, you look at equity markets in Europe, and yes, if you adjust for the FX movement, we are significantly underperforming the U.S., but still, it doesn't feel like the market expects a severe downturn as a base case scenario. It doesn't feel like the ECB expects a severe recession as its base case scenario. But given the energy picture, it feels like maybe that is a bit of a complacent view.
Well, this is an interesting point. I think Germany is a very specific case because obviously they're highly dependent on natural gases. But when you look at the commodity complex as a whole, you look at metal prices, copper, silver, it's down between 15 to 18%, even more from their peak. If you look at the energy prices, they're down to, as we said, to pre-Ukraine Russia crisis levels. So there are clearly big commodity price, energy prices reversal. And this is why energy prices in the US, CPI numbers in the US month on month have hit zero and essentially rolling over. So I think we need to differentiate different markets with the different sort of energy mix and dynamic. And I think when you look at the European equity market, which is obviously exposed to the global economy, you see China cutting interest rate because of a pretty severe recession because of its zero COVID policy. It is not surprising to see equity markets discounting the fact that peak inflation overall is closer than what it was before, and therefore, reducing some of its risk premium. But I do agree with you that in some markets, a harsher recession might be needed if inflation doesn't peak, in which case the equity market might be hit with a surprise through earnings recession, not valuation recession down the road. But at this stage, it's essentially a parallel universe, if you will, where we essentially hopping every couple of days between a soft landing with inflation rolling over nicely and the scenario where inflation gets out of whack and then we hit escape velocity and much higher level of interest rates.
Kokou, can I ask you about the Chinese market? Because looking at a report that you had from June, you're talking about time for China optimism, peak regulation, real estate slump bottoming, and more easing. Well, we've had even further easing. The market has pretty much gone sideways at this point. I don't think any of the concerns have disappeared. There are concerns around a mortgage boycott, concerns around this heat wave now, also in terms of growth fears that have been playing out. What do you make of the opportunity around China? Has it been just a little bit underwhelming versus expectations?
Yeah, I think your last sentence is right. It's clearly been underwhelming. I think our view on China is clearly more on the fixed income side because we think the slowdown is there to stay to some extent, because what's really concerning is really the real estate market, where you're starting to see housing starts falling. There's a clear willingness by the government, the PBOC, to sort of do some cleaning of these massive imbalances in the property market. And I think that could, in addition to the COVID policy, create a bigger drag. And for that, you could see sort of more pressure on risk assets and probably more resilience on the bond market side of things.